Yo guys, Taki here. So this is going to be the most in-depth FVG variance guide. And I mean, you guys already know the drill, right? We're going to be going through all of these, and then we're going to be going through how you can use them, how you can, place a trade off with them, and just any other kind of detail that I keep in mind when I'm actually using these concepts. So let's just get straight into the first one, the inversion fair value gap. Right, so the inversion fair value gap is basically, it's just a fair value gap that gets inverse. So we have a fair value gap, a BPR here, right? We use the volume imbalance to mark out this BPR. Then this BPR gets disrespected. We close below this BPR, and that's when this becomes an inversion fair value gap. And with an inversion, we just basically kind of use this as a SIBI now. Since it was a BPR, we expect it to do the opposite function. So what do we see here? We come up, right? We come up, and then we come below, close below right here. And then what do? We come back above, tap the consequent encroachment, and then go lower. All right, so you want to be using these inversion fair value gaps just as the opposite of what it actually was when it was a normal fair value gap. So if we take a look at something like, okay, let's take a look at something like this SIBI. Okay, this one isn't too clean, but you can see we used it as a SIBI, came down, tapped into it, and then price came down lower, right? So we actually used this as a SIBI once. And then what do? We kind of just chop around, and then we get this strong close above. These are closes above, but it's not as strong, so I wouldn't really trust the inversion yet. But this one is a strong close above, so I would trust this to actually function as a inversion fair value gap now. And what do? We come into the inversion fair value gap, tap into it, and you can see how cleanly price respects it, right? We almost perfectly respected the inversion fair value gap. And then what do? We get a push higher towards this buy side liquidity pool. And when you're using these fair value gaps and inversions, right, you want to make sure you have a good read on the liquidity first. So if we take a look at this first example, what happened was we had this buy side, right? We swept this buy side. This is relative equal highs, right? We have a high here, high here, high here, right? So these are relative equal highs. We swept buy side. So once we sweep this buy side, there's really no reason that this BPR should actually hold as a normal fair value gap anymore, because we already swept the buy side. So the move towards the buy side already played out. So now what are we expecting? We're expecting a move lower towards sell side. So we have a lot of sell side down here. This is kind of low resistance liquidity, right? We have some major wicks down here, right? We have this external range of liquidity, right? So we have all of this sell side that we can kind of target for our move. And that's why this inversion actually works, right? Because there's no reason to go higher anymore. We dump lower, make this an inversion, and then we go lower off the inversion, right? And then once we come sweep all of these, right? We swept all of this liquidity. Now there's no more reason for price to go lower. So what do? We come down, we use this fair value gap just a little bit, but then since there's no actual reason for price to come lower, we just turn this into a inversion, a bullish inversion fair value gap, and we push price higher towards all of this buy side that we just generated, right? We come back lower once again, right? This is not a very clean respect, but come lower and then push again higher towards these buy side liquidity that we generated, right? These are equal highs. What do? Once we tap into this equal high, we also have a regular fair value gap, right? And we go lower. And then once we're on our way down, all of these, so this becomes an inversion. We didn't tap into it, but let's see, let's take a look down here. Okay, so this becomes an inversion. Right, this becomes an inversion right here. Right, and that is because we swept this liquidity pool. Now there isn't very much reason to actually go lower. We resweep this liquidity pool and then we go higher off these inversions. So you can see came above, came below, kind of chopped around, but then once we get this strong close above, come back below into the fair value gap or the inversion, then go straight higher. Right, and let's take a look at this one as well. So now we swept buy side. We have this fair value gap that we're respecting. Right, we swept buy side. Now we want to go lower. So as kind of proof or just as evidence that we want to actually go lower, we have this BPR inverse, tap into it, respect, and then go lower. So and that's how you know we actually want to go lower or we want to go higher, right? You can use these fair value gaps. You can see which one is getting respected, which one's getting disrespected, and then you can also take a look at the inversions, see which ones are becoming inversions and which ones are actually functioning as inversion fair value gaps, and that can really kind of advance your understanding of price action and where price actually wants to go. Next, let's take a look at balanced price ranges or just BPRs. And BPRs, they're very easy. BPRs are just basically fair value gaps and inversions combined. So here we have an inversion fair value gap, and we also have a normal CB. So this overlapping area becomes the BPR or the balanced price range. So if we just get rid of this CB, right, this becomes your BPR because this range right here from the low of this candle to the high of this candle, that's your inversion, and then this range right here is your normal CB, and the kind of area that overlaps with each other is this right here. And you can see came up into it and then went lower. And with BPRs, you can be a bit more precise with where price wants to actually reverse. Because if you take a look at this inversion, or sorry, this regular CB is quite large. But if you can kind of refine it to a BPR, then you can see that it gives you a more precise area where you want to be looking for entries or reversals or just, you know, whatever you want to see happen with this BPR. All right, so let's take a look at another example. We have an inversion right here. We have a regular BPR right here. So what can we do? We can refine this area just to where it overlaps. So we can just delete one of these, and then we can just refine this area. So this is going to be where the inversion and the BPR overlaps, right? And then you can see here we have a more refined area, and this area is actually, it works as a BPR. So what you could do, you could take a trade-off just directly off of it with your stop below the candle that created the BPR, and then just target buy side right here. Right, this would have played out. For another example, let's take a look at, okay, so right here we have another BPR. So this is the inversion. This is the BPR. So then your BPR just becomes this right here. You can see, enter, and then, okay, actually this one you would have gotten stopped out if your stop was below the candle low, but you could put it below this swing low. And then let's see, just target some buy side above, like this, maybe the relative equal highs right here. So we have a high right here, then we have another high right here. So that would be relative equal highs. We also have this kind of low resistance liquidity. You can target all of that, right? And as you can see, it would have worked if you had your stop below this swing low. Okay, so now let's take a look at BPR that failed. So here we have a BPR right here. So we have the inversion and then this large SIBI. So the overlapping areas right here, that's the BPR. And as you can see, we came up into the BPR and then we just went straight through it. And the reason that this failed is because of liquidity, right? We already dumped all of this, right? We dumped so far and we swept out all of these kind of external liquidity levels. So there's no reason that price would come even lower. So that's the main reason that this BPR failed. And what you could have done instead of looking for a short entry of this BPR, you could have maybe looked at just this fair value gap, this SIBI, and then used it as an inversion entry. So we come below, right, sweep all of this out, and then make this SIBI into an inversion fair value gap. What you could have done, entry off of the top into the inversion, and then you could put your stop either at consequent encroachment or like below consequent encroachment or just below the gap, and then you can target something like this fair value gap up here, right? Or you could just target this high right here, or you could target, yeah, maybe this high right here, right? And if you targeted the fair value gap, you would have gotten the 3.5R if your stop was below the inversion. If you had it below consequent encroachment 6R, right? If you just targeted this 4.9R. So, I mean, you can see how well these BPRs and fair value gaps actually work, but you just have to make sure that, you know, everything aligns with liquidity first, because you can see, right, once we come into this fair value gap, we sweep out all of this buy side liquidity. Now there's a reason to go lower, and there isn't a actual like BPR or anything right here, but if there was, I would assume that it would actually work. All right, next we got the first presented gap, and this is just basically your first fair value gap that you get after 9:30 open or when the New York Stock Exchange opens. All right, so we have an example of a first presented gap right here. The stock exchange opens at 9:30. So this is when the stock exchange opens, or the actual New York session starts, not the kill zone, the actual session, right? And then the first fair value gap that we create is right here, right? We have this candle's high, this candle's low, they don't overlap. And then since there's a volume imbalance, we also cover that with the fair value gap. And what you can do, if you double click on your rectangle tool, you can click extend right, because with the first presented gap, you want to be extending it throughout and just use it throughout the entire day. And specifically with the Monday first presented fair value gaps, you want to be using that throughout the entire week. So the way that we use first presented gaps, we can use them as a draw on liquidity or just to see price respect. And that's how you use a normal fair value gap. But you can also use them to give a narrative for whether price wants to go up or down. And you can see here, price came lower, right? Rejected it once and just dumped lower through this first presented gap. So what does that tell us? That tells us that price is very bearish. And once you inverse the first presented gap, it's likely that price just wants to continue going in that direction. So what do we have here? If you can see, right, we have the first presented gap here, and then we just get this dump, and then price just stays below the first presented gap. right? And then we just keep going lower and lower and lower, right? And then now we can take a look at another example. So this is, okay, so here we have the 930 candle, but this is not your first presented gap. Your first presented gap, it cannot come from the candle created at 930. It has to be this one right here. So this one, it's from the candle that was created at 931. So this is your first presented gap. What you can see, we created it, inversed it, and then price just kind of stays above the first presented gap until later on in the day, where we come below, but then we come back up once again and then just keep going higher. So you can see how you can use these first presented gaps just both as, you know, a regular fair value gap, use them as a drawn liquidity or a area where you want to see price reject, but also to form a narrative throughout the day. All right, and then lastly, we have a breakaway gap. And a breakaway gap is when you create a fair value gap without expecting it to be retraced into. So a good example of a breakaway gap would be something like these two gaps right here. What we have here is that we were kind of in this range and then we broke out of this range with momentum. So when you break out of a range with momentum, then the fair value gap that gets created here, you would expect to be a breakaway gap, especially with, you know, how much momentum you can see, right? How much momentum there is. And with a breakaway gap, you don't want to see price come into it. You want to kind of anticipate these to be open, right? To remain unfilled. So a good way to use a breakaway gap would be to put your stop loss there. So if you have something like this is an inversion. So once we close below right here, that becomes your inversion. Take a short. And you can put your stop loss right here because you don't want price to come into this breakaway gap, right? So you can put your stop at the breakaway gap and then just target wherever, like this low or like this. Okay, another example of a breakaway gap would be this one right here, or like these ones right here. What do? We come up, we sweep liquidity, right? We sweep this liquidity, then we get a move lower, a bearish move lower with huge momentum, and there isn't really a good entry here. But what you could have done is you could have entered off of the close of this candle that created this inversion fair value gap, right? So this would be your entry, and then you could put your stop right at this breakaway gap, and then you could just target wherever you want, all the way like down here, or just down here, or, you know, down here, wherever you're kind of comfortable with targeting. And then what you could do is once price comes lower, so once this candle closes, now this becomes your new breakaway gap, or I mean, there can be multiple, but this becomes your like most recent breakaway gap. So you can move your stop to break even, right by this breakaway gap. And with just how much momentum there is downwards, you really wouldn't expect price to actually come back up. And if it does, then that likely just means that your bias was wrong and price is just gonna go higher right here. So that's how you can use breakaway gaps. They're mainly just used to put your like stop losses or to frame a bias for a bearish or a bullish move. All right, so now I kind of want to just put everything together. So liquidity, fair value gaps, inversions, BPRs, breakaways, everything. So first off, let's take a look at liquidity. We just swept out all of this sell side liquidity, right? And then we got a re-manipulation, a re-sweep right here. And then if we zoom in, we can see there is a fair value gap right here that got inversed. So this becomes your inversion fair value gap, right? I mean, you could take a entry off of this, but it's not the highest probability since you only have an inversion to work with. So you could put your stop below this and then just target some highs up here. But after we create this inversion fair value gap, what do we get? We have this SIBI that was inversed, right? And we also have this BISI that was created. So now this becomes a BPR. So the BPR would be right here. And yeah, so this would be our BPR. As you can see, we came up above, created the BPR, came down below, chopped around, but we respected it. So I guess this could be technically your second entry right here. If you wanted to enter off of a BPR with the close or the stop below, the candle would have gotten stopped out. So I guess a good stop would be either below this inversion or just at the swing low. Since if you target all the way up here, your RR isn't very bad, right? And it would make sense that we want to go all the way back up here since we swept all of this liquidity, right? We have this BPR. And also, when you have a BPR, then the lowest swing low, or this swing low right here, this becomes a protected low. And a protected low you wouldn't expect to get swept. So we make this BPR go higher, and then where do we go towards? We go towards buy side, this buy side. We sweep buy side, come lower. Now we have this fair value gap, right? We tap into it, but we leave the consequent encroachment untapped, or yeah, we just stay in the top of this fair value gap, right? So that is very good for a bullish signature in price. We kind of sweep out all of this buy side again, right? So once we sweep out all of this buy side, you would be expecting a move lower. So since we have this BPR, right, you could take an entry off of this with stop above. This would be your protected high. So you could put your stop above that, or I guess above the candle that made the BPR right here. So that could be your entry. But once we come lower into this fair value gap, since we had a lot of buy side swept and we made this BPR, you would be expecting price to just dump below this BISI. But what actually happens is we just tap into it, instantly displace above. So that's a very strong bullish signature. So now you would be thinking that we want to go higher, because if we got this BPR, right, we swept all of this buy side, there's really no reason for this BISI to actually work. And if it does work, and especially if it just gets tapped into and instantly rejects, then that means that the bias is still bullish. So what you could look for something like this. This would be an inversion, right? This would be a BPR, right? And this would also be your breakaway gap, because you never tap back into it. So what could you enter off of? You could enter off of this inversion. Maybe no, you couldn't enter off of it because it never retraced, but you have a BPR right here. So this becomes a protected low, right? We will have this BPR as well right here with the breakaway. And there really isn't a good entry here. Yeah, there really isn't a good entry. So the only entry that you could have gotten is if you entered off of the candle close. So this would be your inversion. Once we close above, right? So right here, once we close above the inversion, you could have entered, and then stop. You could have put your stop below the protected low. You could put your stop below the inversion, or your stop below or at the breakaway gap, right? And then just target higher wherever the draw is. So you could target this, right? Or you could wait for this inversion, right? And then take the entry off of the close right here, stop at the breakaway or below the inversion, or right here, this would be a BPR. So stop below the BPR, wherever you're most kind of comfortable with putting your stop, and then just target the same place wherever your draw is. So you could target this, you could target this. I mean, you could target all the way up here, but I would definitely scale some and then move your stop to break even at least this high right here. If I were to be actually taking this, then I would look to scale at this intermediate term high. I would look to scale somewhere around this. And okay, I mean, this intermediate term high is also a good place to scale. So these would be places where I would be looking to move stop to break even at least, and then maybe scale some. And then once we get this move higher, what do we get? So we swept all of this liquidity. Now we're expecting a move lower. So we have a BPR. So this is now a protected high. Right? You wouldn't expect this to get swept. So technically you could just enter shorts off of the close below and then put your stop above the protected high. But this wouldn't be a very high probability trade just because there isn't enough confirmation. Like you could just target all the way down here. And I mean, it would have worked, but that's just in hindsight, and taking this kind of trade, it's a low probability trade. It doesn't work out most of the time. So what you could do, we have this BPR, then we have this now as the breakaway gap, and then we have this now as an inversion, and then this would be a BPR. This would also be a BPR right here. There aren't really any good entries right here, except you could have taken an entry off of this fair value gap. The consequent encroachment isn't respected very cleanly, but you could have taken this, and then I mean, you could put your stop above protected high or breakaway gap, or just above the BPR, sorry, just above the SIBI that lines up with the BPR, and then just target like these lows, right? And I mean, that would still be a decent trade, 4.5R. If you put your stop at the breakaway, it would have been a 3R, so that's still decent. And then with the protected high, it's 1.8R, so that's not the best. Like, this stop loss is a bit too big in my opinion. I wouldn't want to put my stop up here. I think this one is still a bit too big. I think above the BPR is good. Alright, and that was it for the most in-depth FVG variance guide. If you guys do have any questions, make sure to either leave them in the comments or join my Discord and ask me there. And I would appreciate if you guys could leave a like and subscribe. And I hope you guys have a good time trading.